Welcome to the Dough Roller Money Podcast. I'm your host, Rob Berger. Today in episode 319, we're going to talk about the simple math behind FIRE. Right? We've talked about FIRE a bit, financial independence, retire early, and we're going to cover it from a perspective that I think will be useful to everyone. Whether you want to retire early, maybe you're in your 50s or 60s and you just want to retire on time. Or maybe you're in your 20s and 30s. You don't really want to retire early, but you'd kind of like to know what your number is. How do you even think about how much you should be saving and how much you'll need decades from now when you do decide to retire? So that's what we're going to cover. The good news is it's much easier, at least in broad strokes, than you might think. For today, we're going to talk about a topic that I cover in the book at length. And I've talked about it before, but I think it's important, and I think it really affects all of us, regardless of how you think about retirement, whether you think about retiring early or not. How do we calculate that number? Imagine you're 22, you're out of college, and you want to start saving for retirement, and you think, well, I just want to retire at sort of a traditional age of 65. How much should you save? What's the answer? How do you even think about that question? Or you think, no, I would like to retire early. I want to retire when I'm, say, 50. That's 20. If you're 22, I think that's 28 years. What's that number look like? Or maybe you're 50, you have $50,000 saved in a 401k, you feel behind, you've got some debt, and you just want to retire by the time you're 65 or maybe even 70. How do you do that? Well, the good news is that the answers to those questions, regardless of where you are in your journey, are kind of the same. The way you think through that question and come up with an answer, the math and the steps you take are pretty much the same regardless of where you are in life. There are some differences. And in fact, before we jump into the math, which trust me, I'm going to give you a calculator, and it's not that hard. But before we jump into math, one thing to keep in mind. For those that want to retire at a quote-unquote traditional age, you're likely going to have other sources of income beyond money that you've saved. Perhaps the most common would be Social Security, right? Some of you will have a pension. My mom, who was a former teacher, and she's still a substitute teacher, she has a pension, and many teachers, I think maybe most teachers do. If you work for the government, state or local or federal, you may have a pension. So if you're going to retire at a traditional age, you have other sources of income, which of course makes it easier. I didn't say it makes it easy, but it makes it easier. And that's of course the point of these sorts of sources of income. You'll see why that matters in a minute. So how do we go about, with that sort of caveat, how do we go about, regardless of where we are in life, thinking about, one, what's the number that we need to retire? And given that number, how much should we be saving? Well, as you can imagine, particularly if you've got many years to go, this is not an exact science. It's not a guess either. It's kind of somewhere in between. But we have to make some assumptions. So let's walk through sort of the steps. And for those watching in the video, you'll see I've gone to an article that I wrote years ago on Dough Roller and talked about it in the podcast before, but it's what I call the Financial Freedom Calculator. And if you Google Financial Freedom Calculator, the first entry is this article, you'll find it, and then you'll see in the article a Google spreadsheet that I created eons ago, and there's a link to it, and you can create a copy of it and use it. It's yours, right? So if we go over to the financial calculator, here we go. This is, like I said, it's just a Google spreadsheet that I've created, but it kind of walks through the logic and the steps of making this calculation. So what's the first thing we need to think about in trying to come up? Let's start with our number. We'll do this in steps. So we want to know what our number is. How much money do we need to retire? Once we figure that out, then we'll jump back and say, okay, given that number, how long will it take me to get there? So let's start with the number. And the sort of general rule of thumb within the personal finance space is you need 25 times your annual spending. So just to make the numbers round and easy, if you spend 100 grand a year, you need 25 times that to retire, $2.5 million. Now, immediately, at least in my mind, that raises a couple of questions. The first one is that before tax or after tax, right? Is that, 100 grand gross or 100 grand, after taxes? And how should we think through the tax issue? And I think that there's kind of a simple answer to that, I think, with a caveat, right? It's a lot of caveats today in today's show. The simple answer, I think, is this. If most of your retirement savings is in traditional retirement accounts, so a traditional 401k, a traditional IRA, what that means is, fast forward to when you retire, when you take that money out, it's going to get taxed, right? So given that, you want to think about your numbers on a gross basis before taxes, right? And if you're making 100 grand a year in our hypothetical, and we're assuming you need to spend it all, and out of that 100 grand comes taxes, right? Then, the same is going to be true in retirement. Again, if your money's in traditional accounts, right? Let's just assume you have 2.5 million in an IRA, and in year one you take out 4%. Then you're going to get taxed on it. So you want to think in terms of gross numbers. On the other hand, if most of your retirement is in a Roth 401k and Roth IRA, you're not going to get taxed. So in doing these calculations, you can sort of use after-tax numbers. Now, some of you are going to say, Rob, I've got both. And then you might just make a guesstimate, depending on how much is in Roth and how much is in traditional, and fudge it a little bit. I think, as you'll see, sort of the process we're going through is not intended to be an exact science. I mean, this is think of it as an estimate. When we talk about the number, particularly for planning purposes, it's an estimate, right? When you actually get to the point of retirement and you're doing the numbers, can I retire or not? You're actually breaking out a spreadsheet and budgeting and going through what you're spending and what you think you'll spend in the future and doing the math, right? That's, in times like that's when someone like Mark Zorel could be a big help, right? Or Rick Ferry, who also has a hourly consulting practice, who's really good. But for now, we're just thinking about guidelines. So that's the tax issue, and then the question becomes, well, why 25 times? What's so special about that number? And the answer is the 4% rule. We've talked about it before. And I talk about it in my book. It's actually more a 4% guideline. But the theory behind it is, and they've back tested this, is that you can take out in year one of retirement 4% of whatever money you've saved. And then after that, beginning in year two of retirement, you can take out the same amount, whatever that number happened to be, in our case, 100 grand, but just adjust it for inflation. So if there was 2% inflation, year one, you'd take out the 100 grand because that's 4% of our hypothetical 2.5 million. Again, just using round numbers. And then in year two, you'd adjust for inflation 2%, so you'd take out 102,000, and you'd continue to do that. Now, the idea behind it is they back tested this through good markets and bad markets, and what they said was, as long as you have a portfolio of around 50-50 stocks to bonds, or maybe 60% stocks, 40% bonds, you got a good chance of making it through retirement without going broke, without spending all your money. To put it differently, you've got a good chance of dying before you spend your last dollar. Now, notice I said good chance, all right? I didn't say it's guaranteed. There's no, 4% commission out there or 4% bureau that will step in and save you if you end up spending all your money before you die because either the market turns out to be bad or you live to be 120. So it's a good chance, but it's not guaranteed, okay? And that's just sort of the reality we live in. Now, since the 4% rule came out, it was first written about back in, I think, 1994. There have been countless articles written about it. And some will tell you it's not conservative enough. You should assume 3% or 3.5%. Others say you're going to die with a boatload of money. You can spend 5 or 6%. Everything that I've read and studied tells me that for planning purposes, I'm very comfortable with 4%. I'm certainly not comfortable raising that number for planning purposes. Of course, once you get into retirement, you've been retired 5 years or 10 years and you're older, uh, you might be more comfortable making adjustments, but for planning purposes, I'm certainly not comfortable going above 4%. On the other hand, if someone told me, yeah, I'm going to retire at 28 and I'm never going to do anything to make another dime ever again, and I'm going to base it all on the 4% guideline, I could not. I could not do that. There's just too many things that could go wrong from age 28 to 100, or however long you end up living on this earth, to put it all on the 4% rule. If I were going to retire that early, I probably would go down to 3%, maybe lower. I don't know. But the point is, there's just so many unknowns that can happen if you're in extreme early retirement. Again, it's assuming that your plan is never to make another dime again. So, with all of those caveats, I think the 4% rule is a reasonable assumption for purposes of planning. And if we assume 4%, that's how we get to this 25 times your annual spending, right? Because again, if you're spending 100 grand a year just to keep the numbers round, 25 times is 2.5 million, and then you can just reverse it back out. 4% of 2.5 million is, yes, you guessed it, 100 grand, right? So we know how to figure out our number, right? All we need to know is how much we spend every year. Now, that is generally something we should know. It gets a little tricky, potentially. I mean, maybe one year you spend more or less than normal, right? But a simple way to think about it is, what percentage of your income do you save? And you can go in and add it up. Maybe you contribute to a 401k, great. Maybe you contribute to an IRA. Maybe you're saving for an emergency fund, fine. You can add up what you're spending. You know what you make. Again, some folks have a variable income, so maybe you have to take an average. But again, this is just for planning purposes. That's okay. And then you know what's left, right? If you're saving 10%, you're spending 90%, right? That's pretty simple. And 90% of whatever your income is, again, let's just use round numbers. Let's say you make 100 grand, you save 10 of it. The other 90% goes to taxes and the mortgage or the rent or whatever. And you can take that number, 90,000 in this case, and just multiply it by 25 and you have your number. Very simple, right? Well, kind of. Again, in theory, it's simple, but we can run into some issues. The first one that I get this question a lot. How do I deal with company matches? They match my 401k contributions, 50 cents on the dollar, maybe it's a dollar for dollar match. How do we think through that in terms of this formula? I think the easiest way is this. Absolutely add it into what you're saving. So let's just assume you're saving 10% on your own and the company matches 2.5%. And so that gets you to 12.5%. But you should also add it into your income number, because it is income. It is your employer paying you for your services. They're just paying you, in this case, in the form of a 401k or 403b or other retirement account match. That to me is the easiest way to factor it in. Now, if we really wanted to get technical, some folks, you have a match, but you're not fully vested in the match. It vests over time. You'll have to assess for yourself how likely you think you are to stay at that company in order to fully vest in the company match. And maybe you don't think you'll be there long enough for it to vest, and so maybe you choose not to include it. And, if you end up staying there long enough, great. But that's an assessment you're going to have to make on your own. But again, I think the easiest way to deal with company matches in this formula is to add it to your savings, because you absolutely are. It's savings going into your 401k, but it's income too. So you sort of put it in the numerator and the denominator, right? So that's the first tricky thing that folks email me about. So the first one is the gross versus net. We've covered that. The second one is the company match. The third one I get a lot is debt payments. So you've got student loans, particularly I should add non-mortgage debt payments for the moment. You've got student loans, Maybe you have some credit card debt and you're thinking, yeah, I have this debt and it's part of my monthly spending because I'm making the minimum payments. Perhaps you're paying extra. But once it's paid off, then your actual monthly spending will go down, right? That, at least that's true if you take what you were paying on, for example, a student loan, and you start saving it. Well, that's true. And in fact, when you're thinking about your savings as a percentage of your income, and you pay off a debt in full, student loan, credit card, car payment, and you can then take that money you were putting towards that debt and save it, it's a huge impact on your journey to financial freedom, because you're doing two things, right? You're not just increasing your savings by the amount of that debt payment, but you're decreasing your spending, right? So remember, our number is based on how much we spend. So if we spend 100 grand, 4%, multiply by 25, you get 2.5 million. But let's assume that out of that 100 grand, 10 of it is debt payment. Well, as soon as you finish that debt, you've just reduced your spending by 10%, and you can take that money and you can put it to savings, right? So how do you think about that in doing this analysis? My approach generally is to include the debt payments as part of your spending, because that's exactly what it is. And of course, it's going to mean that a lot of your spending is on a debt that once you retire, hopefully, you'll no longer owe. And so it'll be money you don't have to spend in retirement. But what I find is that once people get out of student loans or pay off their credit card debt, they generally don't take all of that money and save it. Maybe they start saving for a home they want to buy. So it's going to go into a home, and that's an asset, and that's going to have value, and maybe even could be used as part of retirement income, maybe. Although keep in mind, you got to live somewhere in retirement, right? But I find that, or it could be folks want to take nicer vacations, or maybe they want to get that kitchen remodeled. So here you have to just sort of individualize it for yourself. What do you plan to do with that money that's now going to debt once it's paid off? If you're looking at your student loans and you're saying, Rob, I got another 12 years on this, I don't have a clue what I'm going to be doing with that money once I don't have to send it in, for the student loans. I get it. I was there. So it took me a long time to pay off my law school debt. And that's okay. I would just stick with whatever you're actually saving, even though it may not be a number you like to look at right now. And your spending includes your debt payments. Yes, that could end up, once you pay off the debt, drastically reducing your spending percentage, particularly if you save all that money. If that happens, great, and you can recalculate your number. But it may not work out that way. And so, again, you could fudge it a little bit, and you could sort of assume you're going to end up using some of that money to save and some of that money to spend. I tend to want to take a conservative approach. So I tend to just use whatever I'm actually saving as my savings rate. Now, one thing I don't include in my savings rate is money I'm saving for short-term spending. So maybe you're saving up for a car because you want to pay cash. That's great. But that's not your financial freedom fund, right? What we're talking about is your number for retirement or for financial freedom. The same is true if you're saving up for a vacation. That doesn't get calculated into your savings rate, because you're going to spend that money, and you're going to spend it soon, even if that means a couple of years from now. And it's even true with a down payment on a home. I would not include that in your savings percentage. You're going to spend that money. Again, yes, it's going to go to an asset that over time appreciates, but you're still going to spend it, right? So I know I'm kind of throwing a lot at you, but this is how I think through this issue. Again, at one level, it's very simple. You got your total income, great. You're saving X percent, fine. You're spending the rest, boom. Whatever that is, multiply it by 25, and you have your number. If you're going to be retiring at a traditional retirement age, where you're going to have something like Social Security, you can go to Social Security Administration. In fact, I just got an email from them. You can get your annual statement that gives you an estimate of what your benefit's going to be, right? And you can back that out. So just to give you an example of what I mean, let's assume you're going to spend $5,000 a month. That's your expectation. And we'll just use after-tax dollars just to keep it simple. So that's $60,000 a year, $5,000 a month. Let's assume that Social Security and/or pensions and/or some other source of income in retirement will net you $1,500 a month. All right. So now you don't need $5,000 a month from your investments, right? You only need $3,500. So you multiply that by 12 and then by 25, and you get your number. And just since I'm running through these numbers quickly, I'm going to do this on my calculator. 3,500 times 12, that's 42,000 times 25. It's $1,050,000. So you can just back out. The point is, you can just back out what you're going to get from other sources of income once you do decide to retire. And those can, by the way, if you retire early, they could be part-time work that you love doing. Maybe you're doing some consulting. Maybe you start a business that you've always wanted to start, whatever. The source of income, it could be varied. It could be multiple sources of income, but certainly factor that in when calculating your number. Okay, so once we know our number, how do we figure out how long it'll take us to reach that number? So that gets us to this financial freedom calculator. For those watching on YouTube, we're looking at it now, and what it does is you can input your annual income. Right now it's $100,000. That's what the spreadsheet shows, just again to keep the number simple. And it has you can of course change that, and it has a withdrawal rate. Now you'll notice on $100,000 of income and a withdrawal rate of 4%. If we're saving 5% of our money, that means we're spending 95. And because we're spending 95% of 100 grand or 95,000, we're going to need 2.375 million. Again, the calculation is easy. We just take 95,000 times 25, and that gets us to 2.375 million. The interesting thing is, if you were to change the withdrawal rate, it would change the number. So for example, if we said, well, let's use 3.5% withdrawal rate rather than 4, this number is going to go up. And it did. It went all the way up to over 2.7 million. And the reason is because we're taking less out. We still need the same 95 grand a year in this hypothetical, but we're only taking 3.5% out of our investment. So in order to get to that 95,000, taking only 3.5% out, we need a bigger freedom fund. And the reverse is true. If we assume 4.5%, the number goes down from about 2.3 to 2.1. You can change all of these assumptions in the calculator. That's how I build it. But again, when you start out, it shows 4%. And then I have two columns for spending and savings. And you can just look down the column to find how much you're saving. It's in increments of 5%. So let's assume you're saving, we'll start with 5%. So that means you're spending 95. And you can follow the columns over, and it'll show you how many years to financial freedom based on return assumptions. And the way the spreadsheet works, it starts at 5%, it goes up to 9%. And what you'll learn a couple things. First of all, returns matter a lot. I mean, the difference between, say, earning 5% a year and 6% is the difference between 64 years and 56 years. 8-year difference, 1%. Think about that when you're evaluating whether you should pay a financial advisor 1% of your wealth every year to manage your money. 1% is huge. Now, the one thing else I want to show is that your actual annual income doesn't change how long it takes you to reach financial freedom, right? All that depends on your savings rate, your withdrawal rate, and your returns. And let me show you what I mean. If we change the annual income to 50,000 in the spreadsheet, the numbers that show years to financial freedom don't change, right? The actual number you need to hit is lower because you make less, therefore you spend less. But that also means you save less. So the actual annual income doesn't change the numbers in the spreadsheet. You could put anything in here along with your savings rate, you'd have the same numbers. But of course, we want to put something in that's realistic for our specific circumstances. And so that's why it's set up the way it is. Now, you can change the return assumptions in any of these columns. For example, The highest column is 9. I could change that to 9.3, and I have to expand it so you see it, and that'll change the results. I picked 9.3, by the way. That's what I use in the book, because that's the average annual return of a 70-30 portfolio over the last 100 years. But you may say, Rob, I'm a brilliant investor. I'm going to earn 12%. Well, go ahead and put 12% in. Really drops your number, by the way. So if you can earn 12%, you're doing really well. Or you could say, no, I want to be conservative and I want 7.5%. You can put it in, and you can change this all you want. So, so let's look in more detail of how long it takes to achieve financial freedom. If we assume a 10% savings rate, it's going to take, I'm going to assume 9% return, which I think is fairly reasonable. It's going to take you 34 years. Now, let's think about that. By the way, at 8%, it's going to take you 37. So we'll say 34 to 37 years. Let's think about that number for a second. If you started saving when you were, let's say, 25, and it's going to take you roughly 35 years, so 25, 30, that puts you around 60, right? Kind of in the ballpark of traditional retirement. And that's 10%, right? I mean, that's kind of, the old school was save a dime for every dollar that comes into your life. And that basically maps out to a traditional retirement, right? But if you want to be a super saver, let's jump up to 20%. The numbers drop significantly. They basically drop by a decade. Again, it depends on your return, but if you're saving 20% of your income, it's going to take you roughly 25 years to retire, or to at least achieve this financial freedom fund of 25 times your annual spending. And again, there's two reasons why it drops so significantly. It's not just that you're saving more, right? But you're spending less. I mean, the difference, your number, the number you need to hit at a 10% savings rate in our hypothetical of $100,000 income is $2.25 million. When you save 20%, that means you're only, quote unquote, only spending 80%. Your number drops to 2 million. So you get this, what I call the slingshot effect. You're saving more, but you're spending less. So you're able to save more towards your goal, and your goal's gotten easier. It's kind of like, running the hurdles. Not only are your hurdles lower, but you don't have to run as far as everybody else. It's like you get a double shot in the arm, if you will. And so the numbers drop in terms of years to financial freedom by roughly a decade. And if we want to get crazy and go to 30% savings rate, at 9%, it's 20 years, right? 20 years. At 8%, it's 21. I mean, if you're out of college and you can manage to save 30% of your income, you're in your 40s and you've hit financial freedom. That doesn't necessarily mean you'll retire, but you'll basically do what it is you want to do. Now, two important items to add to all of this. The first is inflation, and the second is 30%. Rob, are you out of your mind? Let's start with inflation. That's much easier than whether I'm out of my mind. Inflation is a reality. Well, it used to be. Do we have inflation anymore? I don't think we do, actually. I think we're trying to find it, and we can't. Anyway, yeah, inflation is a big deal. But here's the thing. Inflation is kind of baked in to this way of thinking and this financial freedom calculator, and here's why. You're basing your savings on a percentage of your income. So yes, there's inflation, but you're also going to get raises. I know some years it doesn't feel like you do. I've been there. And some years the raises don't seem like much. But my guess is if you look at your history of work, if you've had much history, you will see that you're making more because you get the sort of the standard cost of living raises. Maybe you get a promotion here and there. Maybe you change jobs and get a bump. But usually if you're following, I'll call it sort of, quote unquote, traditional trajectory in your career. And I agree, I get it. Not everyone does that. And there were times, by the way, when I changed jobs and took significant pay cuts. But if regardless of what you're making, you're always saving, let's assume 20%, then inflation is going to be baked into what you're saving. As your income goes up, you're saving more. And if your income goes down, let's think about this for a moment. Or let's assume it stays flat. You say, Rob, I haven't had a raise in 5 years. What world do you live in? Okay, but if you're still able to save 20% and you're still able to live off 80%, the math still works. Maybe you've just figured out how to do it as prices have gone up over here. You've figured out ways to save somewhere else. If you're able to do it, whatever your savings rate goal is, if you're able to do it, inflation is sort of baked in. And again, as you make more over the long term, hopefully you do, your savings will go up not in terms of the savings rate, unless you choose to increase it, but in terms of absolute dollars. If you're making 50 grand a day and you're saving 20%, that's one number. And if a year from now you're making 52,000 and you're still saving 20%, well, you're saving more. And so the effects of inflation are baked into the system. Hope that makes sense. Now let's get to the tougher question. Am I out of my mind? Probably. A couple thoughts here. The first is, when I read of criticisms of FIRE, and I've talked about some of them in the show in the past, I think some of them are valid. I think if you're going to retire at 30 and never make another dime again, you really need to think long and hard about that. I'm not saying it's impossible. I'm not telling you shouldn't do it, but there's a lot of unknowns when you're 30, and could live to be 100 or older. At the same time, one of the criticisms that I hear is, in order to retire early, you got to save at least 50% of your income, and that's just unrealistic for most people. Well, that just ain't true. You don't need to save 50% of your income. I mean, certainly if you do, according to my spreadsheet, and you earn, let's say even 7%, you'll hit your number in 14 and a half years. But let's assume you just, as we've talked about, let's say you save 20%. You'll hit, even at 7%, you'll hit the number in 30 years. I know 30 years seems like a long time. Some of you aren't even that old. I get it. But if you're 25, that means you hit your number at 55. That's early retirement if you choose to retire. It's certainly, I'll call it, I think a better thing is early financial freedom. That's what we really should call this, not early retirement. I've hit early financial freedom, and here I am behind the mic working. But that's because I want to. So early financial freedom, that's a 20% savings rate, right? You don't need to save what I think most people would view as crazy percentage of your income, although I know people that do it, in order to achieve financial freedom in a reasonable amount of time. Now, having said that, some would say, Rob, I appreciate that, but I can't even save 20%. Or whatever number you're trying to achieve. So two things, and I covered this a lot in the book, but we've covered it on this show. We've talked about the money audit, the one and done system of saving. And I've asked you guys, how are you saving? And I get a flood of answers. You've shopped for car insurance and you saved $50 a month. You've changed your cell phone provider and you saved $50 a month. And the list goes on and on and on. I think you can do it. I think most people can do it. There might be times in your life when you can't. I mean, you may be listening to this and just lost your job. Painful. And, you're just thinking of survival. I get it. But is that our lives 100% of the time? Hopefully not. Yes, there are extreme circumstances, but I think for most people listening to this show, you've got a lot more control over your finances than at least I've thought about in the past. I think many people think. And here's the other thing. So much of saving money we view as sacrifice. There's the whole field that we talk about, the money audit, where none of it's sacrifice, right? If you can find your car insurance for 20% less, you haven't sacrificed anything, right? I mean, you haven't changed your lifestyle one bit. And there's a lot of ways to save that do just that. But here's the other side. I think we spend a lot of money on things that we think make us happy, and in fact, if we stopped buying whatever it is, it would be painful. Well, for the first week, maybe the second. The third week, probably not. And I just speak from my own experience. I've used my mocha example because it was painful to give up the mochas. I was not in a good mood for a very long time. 3 weeks. And I haven't had a mocha in, 2, 3, 4 years. I couldn't care less about one. So, and I've done this. I've run the same experiment with TVs. Going without TV. I know, crazy, right? And you're thinking, well, Rob, that's great, but you're not me. And yeah, you're right, I'm not. And you got to make your own decisions. And I'm not here to preach at you. But I will say this: tomorrow, we're in the middle of July 2019. Tomorrow I take my Volvo in because the lease is up after 3 years. Yes, I leased a vehicle. Feel free to send me hate mail. It was part of my business. And I'm not getting another car. Now, my wife is skeptical of this plan, and I respect her judgment immensely. So it could very well be that I will cave and buy a car of some kind. I'm not going to lease another one in the next couple of months. But my plan is for us to live with just one car, and recognizing that the sacrifice is going to have to fall on me. I'm not going to go down to one car and then hop in it and drive away while my wife is stranded at home without a vehicle. That would not be a good idea. So I'm not going to do that. That's not to say I won't drive it some, but only with her unequivocal permission. That's my plan. But I got a bike and I got 2 legs and I got an Uber app on my phone. So I'm going to go without a car and I'm going to save a truckload of money. I'll let you know how that works out for me. My point is, I think we need to think outside the box. I'm not saying you should give up your car or that you shouldn't drink lattes or that you shouldn't watch TV, whatever. We have to make those decisions for ourselves. But we need to get past that knee-jerk reaction that says, oh, I can't do that. I can't give up that. Think about it. Maybe you can. Maybe life would even be better without it. Of course, then again, I could be driving a Ferrari within a week. Yeah, probably not. That's probably not how the things will play out. So there you go. Pretty straightforward. Remember, this is not an exact science. It's a guideline. You got your income, subtract how much you're saving, not for short-term things, but for your freedom. What's left is the percent you're spending. Take that number. You can just use the calculator here, but you can take that number, multiply by 25. That's your number. And within this calculator, you can see roughly how long it will take for you to achieve that number based on that savings rate, given the return assumption. By the way, also in the spreadsheet, down here for folks that are watching the video to the bottom left, you can, in addition to all of that, add your current savings. And if you add your current savings, that, of course, obviously will shorten the time it takes you to reach your goal. I'm assuming the spreadsheet at the top kind of assumes you've got nothing saved. But if you have money already put aside in a 401k, IRA, whatever, you can put that into the spreadsheet and it will produce a number for you as well. The real key takeaway here is that early financial freedom doesn't take saving 50% of your income, just doesn't. I would say, what my view of early financial freedom probably starts at saving 20%. So again, I'm not pretending that's easy for folks. There were certainly plenty of times when my wife and I were not saving 20%. But it's not crazy. I'll admit to you, saving 50% or more, that's impressive. That's probably not most people. Well, that's definitely not most people. 20%, it's a stretch goal, but it's certainly easier than saving 50%. And of course, as the savings percentage goes up, your time to financial freedom goes way down. I've got finally a big announcement. The book, Retire Before Mom and Dad, The Simple Numbers Behind a Lifetime of Financial Freedom, is available. And I've got a special incentive for the folks listening to the podcast. And I'm also going to include the Facebook group. They're kind of one and the same, although I guess that's maybe not 100% true. But so here's the deal. The book is now available. They call it, I guess, pre-sale or pre-order. And that started in mid-July. And that will continue until, I think it's August. It's the end of August, August 28th. That's when the book will actually ship. And so anyone that orders it before August 28th, that's when you'll get it. And so here's what I'm going to do. For those that order it as part of the pre-sale or the pre-order before August 28th, I am going to hold a free series of webinars. I'm calling them the Ask Me Anything webinars. At least anything about money. Maybe other topics too. I haven't really thought about that. I'm not quite, I guess I should be careful. If I open it up to anything, I'm not exactly sure what you guys will ask me. But the idea, in all seriousness, is, to be as helpful and useful to you guys as I can be. And, I certainly, as you know, I answer questions that you send in to me in shows from time to time. And they've been great, and keep them coming. But the idea here was in a webinar format, you'll be able to type in questions, you'll be able to send me questions ahead of time, and I'll be able to record the webinar so that if you can't make the exact time, you can play it back later. So that's the plan. So what you'll need to do, for those that are interested, if you pre-order the book, and I'll tell you how to do that in a minute, once you do, just shoot me an email, dr@doorroller.net. In the subject line, put book, and I will grab your email. I'll add you to the list. And I'm thinking we'll start the series probably in the middle of September, middle to late September is when we'll begin. My plan is to do at least 4 of them, but who knows? Maybe it'll become a thing. I'm not sure. But it was kind of, the idea was a way to sort of give back for those that have supported the show by listening and that support the book by buying it. So how do you buy it? Well, you can go to Amazon and just search for Retire Before Mom and Dad. For those watching the video, you can see it up there. It's kind of hard to believe. There it is, finally. Or you can just go to retirebeforemomanddad.com/presale, presale. retirebeforemomanddad.com/presale. That'll just redirect you over to Amazon. You can get a paperback version. You can buy an ebook version if you prefer. I am working, by the way, on an audio version. I'm going to be the narrator, for better or worse. And I've been working with a sound engineer. She's tough. I mean, I listen to stuff and I think that sounds great. And she's like, yeah, that ain't cutting it. I've got stuff draped all over the house in terms of trying to block out sound. She's got, I guess, I don't know, an ear for this thing that I don't have. In any event, there will be an audiobook that comes out later. But for now, paperback and Kindle or ebook. So, I'm really looking forward to you guys reading this. And frankly, giving me your feedback. I'd like to know what you liked, what you didn't like, what worked, what didn't work, things you think I should maybe cover in a future book, or topics I should cover on the podcast, questions that have come up. So that's it. Retire Before Mom and Dad. It is finally here. Again, you can search for it on Amazon or just go to retirebeforemomanddad.com/presale. And if you order it before August 28th, please shoot me an email, dr@doorroller.net, put book in the subject, and I will add you to the list, and we'll do some webinars. So that should be fun. Some Ask Me Anything webinars. All right. So I hope this helps you. Please use the Financial Freedom Calculator if you haven't in the past. And if you have any recommendations on how to improve it, love to hear from you, dr@doorroller.net. Of course, love to have you in the Facebook group, doorroller.net/Facebook group. We're over 7,000 now. And if you buy the book, retirebeforemomanddad.com/presale, shoot me an email at dr@doorroller.net, and I'll add you to the list of folks. And we'll do this Ask Me Anything webinar. As I said, it'll be starting in September. Hey, until then, remember, the best thing money can buy is financial freedom.